These are the 4 things that we're going to go through in tonight's workshop. I'm going to touch briefly on compound interest. Then I'll take a break and take some questions. We'll look at how you can balance your risk in investing like an area like Berea with the right kind of proptech tools. Then we're going to look at leveraging bank finance as probably the most easy and cheapest way to finance your first deal. And then I'll talk to you about structuring partnerships with private investors and with angel finance so that you can grow and scale your portfolio at a rapid rate. So compound interest. Now this is, I mean, I can't believe that we're not taught about this properly at schools. I did accounting at school and I learned so much about things that just don't make any sense or add any value, like VAT. I must have spent 2 weeks in accounting learning about VAT. I still have made no use of that. But compound interest, if we were taught this at the age of 12 or 14, and we were told by our parents just to put 100 Rand away every single month, by the time we hit 30, all of us would have been able to afford a car or a house. You know, this is such a powerful principle. Now, let me explain compound interest using an analogy. When I was a youngster, my dad, my friend, and I did this competition, it was like a running competition where you get 10 Rand per lap that you do. You know, those things, those like money raising things at schools. So we went to my dad, and my dad said he'll give us 10 Rand per lap. And we were aiming to do about 20 laps. That was our goal. Then we went to my friend's dad, and my friend's dad said, no, you can't afford 10 Rand. But what he will do is he'll give us 10 cents for the first lap and then double our money every time we complete a successful lap. Now, I looked at my friend and I was laughing at him. I was like, yo, dude, your dad can only afford 10 cents a lap. You know, my dad is paying 10 Rand a lap. But the reality is 10 cents doubled over a certain number of times is going to be much more valuable than 10 Rand per lap, right? So let's look at this together. Now, lap 1 cost my friend's dad 10 cents, okay? The second lap is worth double 10 cents, which is 20 cents, right? The next lap is doubled, 40 cents, 80 cents, 1 Rand, 6 cents, 1 Rand and 60 cents. So by the time we've got into the 5th lap, my dad has paid me 50 Rand. My friend's dad has paid him, 2-3 Rand, right? Doesn't look very attractive. But the whole point about compound interest is the power of time. By the time we got to the 9th lap, that's halfway through we almost made 20 laps. We didn't end up getting to 20 laps. But by lap 9, 1 lap was worth 25 Rand, while my dad was still paying 10. So now we've gotten to a point where his lap, my friend's lap, is worth more than the lap my dad was going to pay me for. Now, if we look at the 15th lap, 1,638 Rand. Go to the 18th lap, 13,107 Rand was the value of the 18th lap. That, guys, is the power of investing. And the great thing about it is you get to access the power of compounding the day you start investing. Now, you might be in a position where you're investing in property already, and that's great. You might be in a position where you've just started, you're just out of school. I know James, we had a call this afternoon. He's a young mechanical engineer. He's starting out his career. You start early enough, you retire early enough. That's the whole point. So start now. As soon as you start, you get access to compound. So let's use a practical example. There is an initiative by the South African government or by SARS that they're giving everybody a tax-free investment account. If you don't have one, please open one up. This is it's a no-brainer. All the profits and all the returns and interest that you get within this tax-free account is never taxed. You can only put in 3,000 Rand per month. That's why I'm using this example. But please, if you don't have one, phone your banker, apply online. All the banks have, different products associated to this. But this is a really, really quick way for you to start investing. Now, if we had to say that you're able to put 3,000 Rand away per month, compounded, it's going to grow to quite a tremendous amount of money over a few years. Let's have a look at this. So I've decided to look at three scenarios. Scenario one is using a compounded interest rate of 6%. So here you can see in year one, by investing 3,000 Rand per month, you'll have invested 36,000 in the year. If we apply 6% interest on top of that, it's 38,000. All right, by year five, constantly adding 3,000, 3,000, 3,000, compounded at a 6%, the value of your wealth after 5 years is 216. By the end of 20 years, the value of your 3,000 Rand per month is now sitting at 1.4 million. That's pretty impressive. Now, if we add the second scenario where we're working on a 12% interest, the value of your wealth and your portfolio is pretty much double what you were earning if it was 6% at 3.1 million. And then the final scenario that I've used is 18%, where the wealth that you would have generated is now sitting at 7.6 million. The only difference between these three scenarios is the interest rate. Remember, as investors, we want to be going for the highest interest rate as possible because that is the rate at which our money is growing. The bank at 5% versus the property at 15% means that the property is going to earn me 3 times the speed at which the property, at which the bank account was. So if you can leverage two things, if you can leverage good returns and compound interest, it doesn't matter who you are, where you're from, eventually you will reach financial abundance because that's how compound interest works. It's all based on the amount of time that you invest in it. So that is compound interest, a very interesting concept. I think the takeaway for me, and I hope the action item that you apply, is opening up a tax-free investment account and investing 3 grand or a grand or whatever it is that you can afford. Start now because compound interest works as soon as you start. Let me take a quick break and see if there are any questions. I see, okay, so Petros, is there a recording? Yes, it'll be on the YouTube channel next week. Okay, let's see here, Masejo. If you heard of an amount of about 50,000, how would you go about getting into property? And the 50, okay. So I'm assuming here that you have 50,000. How would you go about getting into property? And the 50,000 is credit access from a bank. Okay, so the way it works with property investing is that mostly you're going to have to put a deposit down. Okay, if you're going for like a normal property, 2-bedroom apartment, let's say that's worth R1 million, the bank will finance you if you have a good credit score and you have affordability, and then they're going to expect you to put 10% or 20% of the property value down as a down payment / deposit, right? So if you have 50,000 Rand worth of capital available, that basically means that you'll be able to afford a property of, let's say, 500,000, because then you've got the 10% deposit to be able to put down. Now, this is the concept that the banks often refer to as loan to value. So the loan to value is the percentage of the value of the property that they're willing to loan to you. If they give you an 80% loan to value, 80% of the value of the property, let's say R1 million, is 800,000. They will pay you 800, or they will loan you 800,000 to purchase the property, but you have to pay that other 200,000 back, or you have to put that down as a down payment. So with 50,000 Rand, you would probably be able to buy a flat in Berea, where a property is going for 250,000 Rand. That would be possible because you also still have to, on top of that, add your transfer costs and your bond registration costs. So with 50,000 Rand, I would say you'd probably be targeting your Berea, Hillbrow area, looking for property between 200 and 300,000 Rand. That's where you would be able to play, but you would need a good affordability and good credit score. France, how did I get to that 18% example? Yeah. You know what? I can probably share that on the Property Bootcamp. I can share that spreadsheet, and then you guys can play with it yourself. Let's see, Kyle. Seems like you see great value in Durban rental. Would you prefer Durban to Johannesburg, PTA, or Cape Town? To be honest, Kyle, I've never invested in Durban. I mean, I've looked at the areas, but I can't say I have any investments there. My investment portfolio is very much centered in Johannesburg and Joburg South. What I can say is that from a financial perspective, i.e. a gross yield perspective, Durban makes a lot of sense. I would probably rank Joburg still as the top city to be investing in from a financial perspective, followed by Durban, and then probably followed by, the likes of Bloemfontein, Northern Cape. I think Cape Town is one of the lowest ranking, unless you follow the student accommodation / Airbnb model. Okay, let's see here. Darren, can one negotiate a lower selling price on a new build development? What are some of the avenues of considering this approach with a sales agent? So Darren, what I'm going to ask you to do is go check out on my YouTube channel. I've got a video that talks specifically about new builds. You have to understand that new builds have a lot of pros, but they also have a lot of cons. A new build is not going to be positive cash flow from day one. It's most likely going to be a negative cash flow, but you will probably be able to participate in capital appreciation. So please go to my YouTube channel, check out all the videos that I have around new builds. Now, regarding how you can negotiate better with a new build, the likelihood that you can negotiate them down is very low. What you can do is you can get into the early stages of the development. So developers usually go through, 1 to 4 stages. Stage 1 is the early bird. This is where you buy off plan. So they provide you with a blueprint, maybe some mock-ups of what the properties would look like. And they say, here, if you want to buy in, you can buy at 100,000 Rand discount to market value, for instance. Stage 2 is when they've built a couple of units, and then they'll go and show prospective buyers those units, but then they'll still sell off plan. The 3rd and 4th stages is basically when they're just trying to get the last few units sold. Now, the earlier you buy in to the development, the better your chances of getting a low price. But you're also taking the risk. If you buy in at that first stage and for some reason the development doesn't go well, let's say they predict or they plan to build 100 units, and after the 20th unit, they run out of funds. Now, you've got one of these 20 units, but there's a whole bunch of vacant land and the development is just not going anywhere. You take that risk. Whereas if you buy later on in the cycle, if you buy in stage 3 or 4, all the units have already been bought and sold, and you're buying into a more secure investment. So you've got to determine what's your appetite for risk. Are you wanting to go in early to get a good price, but then you're willing to take that risk that it might not work out, or do you want to wait later on? But please go check out my video on new builds. They aren't as good an investment as you might think. Okay, let's jump back into the slides, and then I'll answer some more questions a bit later. This is an important slide because this is showing you probably the 3 tools that I use on a daily basis when analyzing properties. On the left here, we've got Lightstone. Lightstone is a great tool for doing comparable analysis. It shows you what the properties in that area have recently sold for. It gives you trend analysis. It tells you what the capital appreciation might be. It tells you what the outstanding bond is, what the last sales price is. It gives you a lot of information around the property that you're looking at. TPN is a fantastic tool when looking at trends from a rental perspective. So seeing your vacancy rates, your delinquency chances, the education level of the people that you're trying to target, that area, the employment track record. So you can start to do a lot of research. Let's say that you're investing in Berea, but you live in Cape Town. You don't know anything about Berea. You can use TPN to get really, really accurate, detailed facts about what the risk of investing in an area like Berea is. That's what allows me as a Cape Townian to invest in Joburg, because using these tools allows me to gives me that local knowledge that usually you would have to rely on an agent for. And then finally, the myapp.property app, which is a deal analysis tool, right? You plug in the inputs, it gives you an output and says your ROI will be X, and you can determine whether the return justifies the risk. So you've got to balance your risk with these tools, because these tools give you data or give you unbiased data to make an informed decision. Now, I don't have the time in this specific workshop to go through each one individually. I do have, about 10 or so videos on area research on my YouTube channel. So Lightstone, TPN, myapp.property app, you can go check them all out on my YouTube channel. What I will show you is how you can vet a tenant. Now, if we look at these 2 scenarios, the most common question I get about investing in Berea is this. People are always like, but dude, what about delinquent tenants? How do you do an eviction? How do you deal with bad tenants? That's probably the most common question that I get. And the answer that I can give you is, don't do an eviction, do the vetting correctly. So instead of trying to get the wrong tenant out, make sure you get the right tenant in. And now this is where TPN's tool can come really in handy. So TPN calls it their rent check, a fancy word for a credit report on a specific tenant. Here is an example of a credit score that I received for one of my apartments. This was a tenant that was applying. Their credit score is an F. From A to F. F obviously is not a good thing. If any of us went to school, we know that F is the bad one. In terms of their payment history, they have a very poor payment history. They are highly unlikely to afford to pay the rent, and there is an average chance of them squatting. All right. If we look at their credit card payment history, the red is showing you where they've missed payments, and the green/yellow is showing you when they've made payments or partial payments. So from this perspective, you can tell that this is a horrible tenant. I mean, you don't need to go through thousands of workshops to see that this person is going to be a problem, right? You can see that 50% of the time they miss their payments. Now, this is probably, if you had to think about Hillbrow, you'd probably think that this is every tenant, and that's just not true. This is a bad tenant. This is the kind of tenant that I would be like, there's no way I'm going to put you in my property because you're going to be terrible. Let's look at a slightly more positive version, right? So this was a tenant that I recently placed because their credit score was really good. And for the last 6 months that I've had this tenant, they haven't missed a payment. So this credit score approach is a really, really effective way to vet the right tenant. So their rating from A to F was a B. Their score breakdown is a good payment history. They are probably able to pay. And there's a very low chance of squatting. For me, the most important variable is this one here of squatting. If a tenant comes in and doesn't pay, that doesn't irk me that much. I mean, I don't love it, but I'm okay with that as long as I can get them out without a hassle. When you start having someone who stays in a property and squats, and you have to start paying legal fees to get them out, that's where it starts to become very costly. I mean, when you're looking at a proper eviction process, you can look at anywhere between 30 grand to 100 grand, and it can take anywhere between 3 months and 12 months. Now, there are some ways in which you can get around that, especially when you're in the low income market. But the reality is that you want to make sure that someone can afford your rent and that they don't have a very high affinity towards squatting. Now, here you can see their payment timeline. Okay, yeah, they've missed a couple of payments. Unfortunately, guys, when you're targeting the low income area, you're going to have that. It comes with the territory. But look at all the green bars and look at the ratio between good payments versus missed payments. And this person is sitting at a 94% good standing. So what I can do now is I can say 94 minus 100 means 6%. 6% is my void percentage. So I can run my numbers and say I've got a vacancy cost of 6%. I'm assuming that 6% of the year, this tenant is going to default. If my numbers still make sense, even with that included in the numbers, then I know that I'm making a good investment. Right? That is where tools come in that are really handy towards not only making a good decision, but making a good decision based on facts. Okay. So these are the 3 tools. Please write them down. Go check out my YouTube channel if you want to understand a little bit more about each one of these in more detail. But these would be the 3 key tools that help you get that data-driven approach so that you can make an informed decision. Okay, quick break. Let's do 1 or 2 more questions. Is it possible not to be associated with the debt if a group is crowdfunding to buy properties via PTY, i.e. 10 ladies contributing 10K per month? How do we get around taxation? Okay, so you've got 2 questions here. One is around what the debt or the liability will be if you have 10 people participating in a business. And then you also have around the taxation. So this is a big question, but a good one to ask. So regarding debt, when you have a PTY, you've got 2 types of people in the company. You've got directors and you've got shareholders. Now, shareholders are people that get a portion of the profits in the shares from being invested in the business. The directors are those chosen by the shareholders to manage the business. Okay. Now, the directors are those who are held liable for all the debts and all the debt within the property, within the company. The shareholders are not liable for that debt. Regarding the taxation, now in a company, your tax is at a flat rate of 27%. So whatever the profit is that you make in a year, 27% of that goes to SARS. If you want to get the money out of the business, there's 2 ways to do that. One, you can pay dividends. So you can pay all the shareholders a little portion of the profits. I think the dividends tax rate is 18%, but I stand under correction. So after the 27% has been deducted, whatever's left over, you can pay out as dividends to your shareholders at an 18% tax rate. Please just check SARS's website to make sure. And then number two, the second way in which you can exit that money out of your company is through salaries, right? So you can pay all the 10 ladies a salary every month. And then that money that comes as a salary to them, they'll have to pay tax in their own personal capacity, okay? So number one, you have to pay the 27% tax within the company entity. To get the money out, you're either going to go through dividends, 18%, then it lands into your pocket, or you're going to pay yourself a salary, which then means you're going to pay income tax on your personal rate, whatever that is, on that money. Okay. Petros, I hear you mentioning compound interest. What exactly is it and where to invest for one to take advantage? So compound interest is when you have money. Let's say you put in 1,000 Rand and you make 500 Rand profits. Now you've got 1,000 plus 500. You've got 1,500. Then you get interest on top of that. So it's interest building on interest. Let me start here a bit low. So it's interest building on interest until eventually you have an enormous amount of wealth. Think of nature, right? If you have a tree starts as a little tiny seed. And eventually it grows and it grows and it grows, and then it becomes a little stump. Now, the thing is, as the tree grows, it compounds because it's already growing from a bigger base until eventually it becomes a full tree. It's the same thing with wealth. You have to put money aside into an account where you're getting some sort of interest, and it has to compound until eventually it grows. So in terms of where to invest, that's the $1 million question, man. You can invest in a bank account, you can invest in a property, you can invest in stocks, you can start a new business, you can loan money to people. There's different ways in which you can get a return. Okay, let's do 2 more questions. Vishal, where does the information on TPN pull from? So that's a great question. So TPN connects with the deeds office to get a whole lot of information about the property, but they also they've got thousands of landlords that use their technology to track their tenants and to send invoices and to manage their cash flows. So they take all of that internal information and they create they basically create they use data science to be able to present you with information. So they basically use live data in the field, and that's why I think they're so valuable. Let's see. What should be the tolerance between municipal value versus market value versus purchase price? Great question. So let me start by saying that your municipal value means nothing. Maybe I say that with a pinch of salt. Sometimes it can be accurate, but from what I've seen, your municipal valuation is usually 3-4 years out of date, and it's usually highly unrealistic. The way in which I determine the best market value or the most accurate market value is through Lightstone. By using Lightstone, you can see what properties in the last 6 months sold for. So the key thing that you want to do is when you've got your Lightstone report in front of you is you want to look for the properties that are most similar to that property, right? You want to compare oranges with oranges. So you want to find a 2-bedroom. Let's say you're looking at a 2-bedroom. You want to go onto your Lightstone report and find all the 2-bedrooms that are in that same street or in that same suburb and see what they sold for in the last 6 months. That's going to give you the most accurate reflection as to what the market value is today. In terms of purchase price, once you understand your market value, I think you should go at 10 or 15% below that as your offer price or as your purchase price. Okay, let's go back to the slides. Okay, let's talk about money. Leverage. Guys, this is the most important thing and why I believe property is the best investment, because you can get leverage. If you go to the bank and ask them for money for stocks, they're not going to give it to you. You can go to ABSA and say, listen, I want to buy ABSA stocks. Please loan me the money. ABSA's not going to loan you money to buy stocks. You can ask ABSA to loan you money for buying gold. They're not going to give you that money. But go to them with a property investment. You've got a good affordability. Your credit score is nah. Go to them with a property investment. They are most likely going to loan you the money. With leverage, you can use other people's money and other people's resources to build and scale your business. So money is a tool that can either fix you or damage you. Depends how you use it. Now, when I use the term debt, a lot of people in South Africa cringe. And I'm not surprised. I think we have a very unhealthy association to debt, because most of us, when we think of debt, we think of the picture on the right there, the credit card, where we have monthly payments and we're just struggling to get by. But that's not the only use of debt. Remember, Money is a tool. You can use it wisely and it will help you. You can use it poorly and it will damage you. So when we look at debt, I like to look at this in terms of three categories. You've got what I call good debt, bad debt, and ugly debt. Your good debt is when you are buying an asset like a property where the rental income covers the expenses and you're left with a positive cash flow. That's good debt. That means you're leveraging other people's money to build an asset that's going to just keep making you more and more and more money. Bad debt is the example of buying a car that you don't use for Uber. Let's say you want to buy a fancy Mercedes, you want to go and impress your friends. Now you have to pay the bank back every month 5,000-6,000 rand. They're going to take that from your salary, which means your affordability goes down. And you don't have any assets. You don't have any value there. I mean, your car is still worth something. So that's why you could probably sell the car or repossess it and at least cover your debt. So it's not the worst use of debt. The worst use of debt is that of ugly debt. That's where you're using your credit card to buy luxury and lifestyle items, to go on a traveling holiday, spend 30, 40 grand on your credit card to go to Mauritius or wherever it is you want to go. That's an example of ugly debt that's just going to put you in a worse situation. So when you're looking at debt, you've got to try and remind yourself that it's not always bad. There's such a thing as good debt. Now, let me show you an example of how good debt can play an incredibly important role for you. Let's imagine that you have 300,000 rand set aside somewhere. Okay, either your family has that money or you've been saving it for a couple of years or whatever it is. You've got access to 300,000. Now, your goal is to go and take that 300,000 and invest in property. Okay, this is the property that we're going to use as an example. So 1-bedroom apartment, it's in the low income CBD area. Okay, now we're going to look at two scenarios. Scenario one is to buy the property cash. Okay, we've got 300, we can buy this property cash. The second option is we're going to leverage debt. We're going to get bank finance. We're going to get the bank to give us a portion of that money. Okay, now if we look at the cash scenario, the rent on this property is 5 grand. There's no bond, because you're paying cash. You don't have any bond repayments, which is lacquer. Your expenses is 1,800. That's your levies, your rates and taxes, your insurance, some of your provisions. You're making a cash flow or a profit every month of 3,200. You've had to invest 300,000 into the property, 250 to buy it, plus then your legal transfer and bond registration costs. Your return on investment, which is the cash flow times 12 divided by the capital you've invested, is 12.8%, which, realistically is not bad. Most banks are offering, 5, 6, maybe 7% interest. So to invest in this property means that you're getting a substantially higher return, or your money is working harder for you than it would in the bank. Now, let's say that you go to the bank and you say, you know what, I want to get an 80 or a 90% loan. So I'm only going to put the deposit down and I'm only going to pay the buying costs. Now, your rent is going to be 5,000. Your bond in this example will be 1,744 rand. You can either use the myapp.property tool to be able to help you work out all these numbers, or you can just use Property 24's bond calculation. Here you can see I put in the purchase price of 250 with a 10% deposit at a 7% interest rate, and the bond repayment is over here, 1,744. My total costs in the deal will be my deposit of 25, bond registration and transfer fees. So I'm in the deal for 54,000 rand. Okay, so not 300 like I am with the previous deal. Now I'm in here for 54. Okay, so the expenses don't change, and the cash flow is now obviously a lot less, right? Because you've got this big expense being your bond. So now your cash flow is sitting at 1,456. The capital you've invested is 54,000. Now you take your cash flow, you times it by 12, and you divide it by the capital you've invested to get your return on investment, which is sitting at 32%. I think that deserves a little glass, not a glass, just a sip. Basically, what this is saying is that using bank finance means that your money is going to be working 3 times harder for you. Instead of getting a 12% return, you're getting a 32% return. Guys, this is an example of good debt. Not only am I getting a better return, but I'm also able to buy more properties. Because remember, you've still got 300,000 rand. So that means 300,000 divided by 54 is basically 6 properties, or 6 properties. Using the bank's money, And taking your 300,000 and dividing it, you can buy 5 properties versus buying 1 property cash. And I've seen so many people go for the cash option, and I get it, because if you pay cash, there's no bond, there's very little risk. I understand that people feel that there's more security in cash. I get that, but the power comes with leverage. The returns come with leverage. Financial freedom comes with leverage. If you're going to be using only the cash you've saved up to invest in property, it's going to take you very long to build any kind of substantial portfolio versus using the bank's money to get ahead. Now, let's talk a little bit more about bank finance, because I believe that this is probably the easiest way to get into property, but it's also the cheapest form of finance. Now, when you do want to get a bank loan, the banks are quite anal. Sorry, I should use a different word than that. The banks, sorry, this one is going straight. The banks are quite strict. The banks are going to look at you and they're going to expect these 3 things. A good credit score. If you've got a judgment against your name, if you've got some sort of blacklisting, you're going to struggle very much to get a bank loan. That doesn't mean you can't partner with someone and use their credit score and their affordability. But if your credit score is in shams, you're not going to get a good loan, right? So go check out this website, clearscore.com. It's completely free, and it will give you a sense of what your credit score is and how you can fix it. The second thing that the bank's going to look at is affordability. How much can you afford to pay them back? How much are you basically making in terms of a salary? And then they will allocate a value, and they'll say, okay, cool. Well, based on how much you earn every month, we'll give you a loan, or a loan facility of R1 million, for instance. And then finally, what they'll do is they'll look at the deal. So if you're buying in an area like Berea, they'll go and review the building's financial statements. They'll go look at make sure the building's insured. They'll look at Lightstone to make sure that the market value is fair. They'll do all that research, and they'll make sure that it's a good investment. Okay. Now, affordability, if you don't have these 3 things and you don't have a good affordability, the banks are not going to be your friend. Again, that doesn't mean you can't partner with someone who's got a good affordability, but if you're looking at bank finance, you have to hit these 3 things. Otherwise, they're not going to look at you. Now, if you've got a decent affordability, you've got a stable job and a decent salary, you can use the banks as an infinite source of financing. Let me explain. Okay. So affordability. Here are some stats that I got from APSA. Now, only 73% of investors are sitting at 1 to 2 properties. So people who invest in property based on APSA's database is 73% sit with 1 to 2 properties. Only 16% are between 3 and 10 properties, and even a smaller amount, 12% own 10 properties or more, which is kind of disappointing. But the reality is, because people are buying liabilities, not assets. Okay, let me explain. When most people look at property investing, they look at this and they think this is an asset. Edenvale, it's in Joburg East, the East Rand. You can see this is almost like a new build. This is your complex living. This is super popular. This is what most people will associate with a decent deal. Now, I'm not saying it's a bad deal, but from a cash flow perspective, it's terrible. Here you can see that the rent you're going to get is 9,000 minus your expenses of bond, levy, rates and taxes, management and voids. You're losing about $1,500 every month, which is money you have to take from your salary. So if we're looking at those kind of deals, they erode your affordability. Right? If you've got a salary of, let's say 30,000, the bank's going to take roughly a third of that and allocate that towards being able to give you a bond. So a third of 30,000 is 10,000, and the bank will probably look at that and they'll say, okay, cool. Well, you're probably good enough. You're good for $1 million to $1.5 million and $1.5 million rand loan. Okay. Now let's say you buy property 1 and it's losing 1,600. That means of your 30,000 that you get every month from your company, 1,006 is being drained by this Edenvale property. Right, then you buy your second investment, which is losing 3.5, and then you buy your third investment, and you're losing now 4,850. By the end of the month, your 30,000 rand salary that you're getting is now only worth 20,000 because you've got these 3 liabilities draining your money. This is why I don't like the new build strategy, because new builds, 9 times out of 10, are negative cash flow. Now, the new builds, before I throw new builds under the bus, new builds are very valuable and very helpful when you've already got a cash flowing portfolio. Like, for example, I'm in the position now where I've got a couple of units and I've got a sizable positive cash flow investment thing going. Now, what I'm going to do is I'm going to go and buy 5 new builds, because those 5 new builds are all going to be negative cash flow. So what that means is all the profits I'm making in my portfolio are going to be reduced by the negative cash flow of these 5 units. Plus, when I buy 5 new builds, I get to access the Section 13 Sex Act, which allows me to get 55% of the value of these 5 properties back in tax rebates. So basically, I'm buying the 5 new builds at half price. This is the way you can kind of look at it. So new builds have a very good place in your portfolio, but from a cash flow perspective, they're not good. From a monthly profit point of view, they are not good. Now, let's look at another example. Let's say that you start investing in your lower income market. You go for the Bereas, Rosettenvilles, those kind of areas, right? You buy at a discount. So the property here is valued or is asking at 400, but you come in at 320, right? Buying low is a very, very key success criteria to investing in property. Your monthly cash flow on this deal is going to be 2,300, right? Because your rental is so much higher than your purchase price and your bond. If we go back to our Edenvale deal, the rent is 9,000. It's just covering basically your bond. And then you've got a very high levy and rates and taxes cost. By the end of the month, you don't have anything left. Whereas in your low income market, your numbers make a lot more sense. Your rental income is 3 times higher than your bond, right? So you're walking away with a nice 2,300 Rand profit. If we go back to our affordability, my 30,000 Rand salary is now increased by 2,300. I go to the bank and I say, hey, I've got 30,000 Rand plus I've got 2,300 Rand coming in profits. Then you buy another 2 properties, let's say. You buy a student accommodation property and a multi-let, and you make an extra 3,600 and 4,000 Rand in positive cash flow. At the end of the month, your affordability is now sitting at 40,000. So in the bank's eyes, you're making more money. And when you make more money, the bank gives you access to more money. Are you seeing how investing in positive cash flow, low income housing in the beginning of your property journey is so important, because it allows you to build and build and build and build. And eventually, when you're at the right level, let's say you're making 30, 40, 50,000 Rand in positive cash flow every month, you don't have to work anymore. That's when you go and buy 5 new builds. That's where you go get the negative cash flow from these 5 to lower your profits and lower your taxable income. Plus you get the tax rebate from the 13 Sex Act. Plus you get the capital appreciation that comes from these 5 investments. Because your cash flow strategy, when you're investing in low income areas like Berea, you're not going to have much capital appreciation. That just comes with the territory. You're either going to have a strong cash flow or you're going to have a strong capital appreciation. To find both in one deal is very tricky. But as you've built up your positive cash flow portfolio, you can then start buying into the new builds. At least that's just my philosophy. I'm definitely not. I'm not a financial advisor. I'm not registered or anything like that. So please note that all the feedback and all the advice I give you is just from my personal experience. But that's the way I would go about it. It makes a lot of sense to me that way. So that's leveraging finance, a tool that can either fix you or damage you. If you use debt wisely, that's what you need to do. Okay, let's quickly jump into some more questions here. Okay, Hilma. What if the tenant went through a rough patch, but eventually got a job and earned enough income to afford his rent, but his credit profile was affected by his bad situation previously? Yeah, I mean, I think that's a fair comment. If I had to see someone with a very bad credit score, but they told me that they were going through a rough patch, especially with COVID, I would agree. I would say, okay, cool, that's fine, but then show me 3 years worth of payment history. If the last 6 months are a really bad reflection, I can accept that. But then show me 3 years, and if the 3 years shows a more positive view, then I'll reconsider. But from my perspective, when someone's got a bad credit score, it's very clear to see that they're going to struggle in future. This COVID situation was obviously a big upset for a lot of people, and it's definitely something that needs to be needs to be taken seriously. But I would say then look for 3 years worth of credit history. Darren, should you buy your first property in your own name or business name? So it's a good question. Now, if you're looking to build a portfolio, I would say a company is definitely the best avenue. I would say you need to have a trust. The trust owns the shares of your company, and your company does all the property investing. But having the trust own the shares of the company means your estate duty or your future planning is sorted. And having all the properties in a company means you can trade within the company's tax environment. If you're looking to do a flip, which means you buy low, sell high, or you sell for profit, I would say do that in your personal name, because SARS has a really cool incentive that says if you make a profit off your first flip, so the first property that you buy, live in, and sell, you're exempt from capital gains tax of up to 2 million rand. So basically, you can do a flip where your profit is less than 2 million and pay 0 capital gains tax. So the only time that I would recommend that you buy a property in your personal name is if you're looking to flip and you want to take advantage of that tax rebate. Otherwise, company is the way to go, again, in my opinion. What is the best ROI percentage in property investment? The best is an infinite return on investment. That's where you've got no capital in the game and you're making a return. That's the best, right? That's the dream. We call that a no money down deal. I've done like 1 or 2 of those. They're really hard to come by. The way you can do it is by buying at a massive discount. Let's say you've got a property that's worth $1 million and you buy it at 600. Okay. Now you go to the bank. The bank's going to give you a loan at the 600 value because the bank loans on the offer price. The bank doesn't loan at the value. They give you a loan at the offer price. So they're going to give you, let's say, 90% of the 600,000 Rand value. Okay. Now, 2 or 3 years later, what you can do is you can go back to the bank and say, listen, I'd like to get a new bond on my property, and my property is worth $1 million. So now what the bank will do is they'll go do their research, they'll check Lightstone, all of that stuff, and they'll find that the value is $1 million, and they'll give you 90% of the $1 million Rand valuation. Right? Now, if you bought it at 600 and your loan facility is now pushed up to 90% of $1 million, which is 900,000, you're basically getting paid to buy a property because your money in the deal will be less than 900,000. I don't know if I'm explaining this correctly, but basically if you can do an equity release or refinance your property, you can actually pull out more money than you put in, and then you have an infinite return on investment, which is kind of the best thing. Okay, Pumzile, what is a good credit score? I mean, each institution has their own ranking and valuation model. I think within ClearScore, anything sort of above 550 is decent. I would definitely recommend ClearScore. It's a free service. Go check it out. They're very clear with what is good, what is bad, and how you can go about fixing it. Tumeleng, when into building property for rental, like a block of flats, can you apply for financing from the banks without applying for a personal loan? Okay, so if you're looking at buying in a block of flats, so when you're looking at buying in a block of flats, before COVID, I would be able to get a loan on a block of flats. If I was buying 10 units, I could get a loan on that block of flats. But now since COVID has come around, the banks are a little bit more hesitant. So actually what happens is if you want to buy a block of 10 flats, you have to first sectionalize those 10 from 1 title deed to 10 title deeds, and then you're able to apply for 10 home loans. It's kind of, you kind of have to have the cash to be able to pay for that. Let me quickly go into the final section. Okay, so here we're looking at the power of partnerships. Okay. Now, when you're looking at partnering with people, which I highly recommend, you can look at people in terms of four ways. You can partner with someone because they have capital. You can partner with someone because they have experience. You can partner with someone because they have skills, or because they have time available. Now, because of my background and because I've been investing in property for a long time, I have the experience and the skills to invest. But what I sometimes lack is the capital and the time, right? Because I'm doing several deals at any given time, I don't have the financial abundance to be able to put my capital into all these deals. So what I have to do is I have to rope people in, and I have to give them either a loan or I have to give them equity shares into my company so that I can raise the capital to be able to purchase properties. Does that make sense? Right. Now, if you can't get bank finance, you might want to look at this partnership model, or what we sometimes refer to as private finance. Okay. Now, as I was explaining to Ntumeleng around the finance restriction, pre-COVID, I would be able to buy a block of flats without any financing, but now I have to buy the property cash, or the block cash. I then have to go through the process of sectionalizing the property. And then once I've got the property sectionalized, I can go to the bank and I can get a home loan for each sectional title in the block that I've just purchased. Okay. Now, because that has become a restriction since COVID, I've opened up myself towards partnerships, right? So a couple of weeks ago, I did a presentation to 10 or so potential investors, guys who had reached out to me on my YouTube channel. And I pitched them these 4 deals. These were 4 blocks of flats and investments that I was currently looking at. And funny enough, the investors are really interested in the one here called Great Court and Isle of Port. And those are the 2 latest investments that I've added to my portfolio. So let's have a quick look here at Great Court. Asking price of 2.8, offer price 1.9. Guys, key to successful investing, buy at a discount. Nice 30% discount is a great starting point. Now, as is, currently the property is not a good investment. And the reason is because it's not being managed correctly. As you can see here, the cash inflow is 34,000. The cash outflow is 25. The cash flow is 9,000. The return on investment, because remember we have to buy this cash, is 2.3 million, sitting only at 4.46. It's not a great return. Now, the reason why I still believe this is a good asset is because if managed correctly, it can be a very good asset. Here, this red line is where all the problems are. Number 1, rates and taxes for a building this size shouldn't be more than 2,000, 2,500 Rand. And then water and electricity should be charged onto the tenants. That's very common in these low income markets. You put in prepaid electrical meters, prepaid water meters, and then you don't have to pay that. Your tenant pays for that. Right, so this 18,000 Rand expense that's coming on a monthly basis is purely due to the landlord not managing the asset effectively. So what we've done is we've now purchased this property, and we're going to change this around by inputting some prepaid water and electricity meters and by reducing the rates and taxes. So once we've purchased this property, the cash inflow, the rental will be 30,000. The rates and taxes will be 2,180, and then the water and electricity we will on-charge to the tenants. The cash flow on a cash purchase will be 21,000, which gives us a return of investment of 10%. Right, it's not super sexy, but the reason why it's not a great return is because of this huge cash number here. We've had to pay cash because remember, the banks aren't lending. Right. So once you've now bought this property, we can start the process of refinancing. Now, this is where you can start to access equity, which is very exciting. So on this block, it is currently it's on one title deed. So currently there is just one title deed for this entire block. It's six 3-bedroom properties. So our first step is we're going to have to sectionalize this property, right? So take it from one title deed to 6 individual title deeds. In order to do that, I mean, there's a whole lot of stuff you have to do. You have to have approved building plans. You have to have approved sewer lines. There's certain metrics you have to follow, but you have to just speak to a town planner and a quantity surveyor, and they'll be able to give you this information. Now, once I've got the 6 title deeds, I can go to the banks, to the APSAs and the FNBs and the net banks of the world, and I can ask them for 6 individual home loans packaged as one home loan, right? And this is where I can get now my money back out. So yes, I purchase it with cash, I refinance, I sectionalize, I get them into 6 units, I then refinance and I get a loan on all of them. Now, the cool thing about this specific deal is that once it's refinanced, the value of the property will be about 3 million. Right, so if I open up my calculator here real quick, let's say that 3 million is what I could sell it for, or what the bank says it's worth. The bank is willing to give me, let's say, an 80% loan to value is 2.4 million. If you remember from the previous slide, we invested 2.3, so I'm minus 2.375. We are being paid. Once this property has been refinanced, we will, as the partners, as the people invested in this business, will make 24,000 Rand. I hope that's hitting home. I obviously can't see you guys, but I'm hoping that a little light bulb has gone off and says, wait, I can get paid to buy property. I mean, yes, you have to pay, you have to buy the property yourself. You can see here, we're buying this property for 2.4 million. We're putting that money up front. But once we've gone through the process of sectionalizing, the value of the property is now higher because we've taken it from 1 title deed to 6 title deeds. We can now actually extract all of our money and be left with a profit of 24,000. And then once we get that 2.3 million Rand back, all we're going to do is reinvest it into another deal. It takes about 18 months to sectionalize, get that money out, reinvest, reinvest, reinvest. That's how you can recycle money. And it's all about leverage, all about leverage. Once we've refinanced and we've put in a bit of development, we're going to convert the garages into a couple of additional rooms. The return will be 15%, and the internal rate of return, which is basically the performance of the asset over the lifetime, is 20%, which is pretty phenomenal. So yeah, some exciting stuff happening there. In terms of being able to structure this business, I don't have 2.4 million. I wish I did. If I did, I would have done this deal myself, but I didn't have that capital. So after doing that presentation, I had 5 people come up to me and we decided to start a company, and we called the company Kulusizwe, which stands for Growth of a Nation, if I'm not mistaken. And our partners are these 5 people. So me, I will be the CEO. Obviously, I've got the experience. Thierry, some of you might know him from some of my other videos. He's an accountant, works for KPMG. He will be doing our taxes and managing that kind of portion. Wesley is a guy that's been investing for 20 years. He's had a portfolio and he knows how to manage the operations. So he will be working closely with Rob. And then we've got Tumi, who I'm not sure if she's on the call tonight. She usually is, but she's a phenomenal person, and she's what I call the pipeline manager. And she's the only person that lives in Joburg, funny enough. Thierry and I live in Cape Town. Wesley and Rob are international people. And Tumi stays in Midrand. So Tumi has become our pipeline manager, which basically means that she needs to find the deals, she needs to negotiate the price with the estate agent, she needs to go and do the viewing, meet with the building inspector, pick up the building plans. So she has to do a lot of that work. Now we all play a different role, and we've all contributed a different amount of capital. Okay, so you can see that Wesley and Tumi, being the 2 most the oldest people, age experienced people, are putting in more capital, right? Myself, Terry, and Rob, we're all 30. We only have so much that we can invest. So what Wes and Tumi are bringing is the bulk of the capital. What I'm bringing is the bulk of the experience, okay? Now, the way that you usually want to structure a company, the fairest way is the capital you bring in equals the shares you get. If you're going to put in 10% of the capital, you should get 10% of the rental income. Done deal. It's simple, it's clean, it's fair. Now, the question is, especially for someone like me, I've got all this experience and all the skills, and I'm bringing all this value to the team, but because I don't have the financial strength that a Wesley or Tumi has, how can I still participate in the same level of shares? Right. That's where sweat equity comes into. So if you don't have the capital, but you've got the time or the expertise to be able to add, we call that sweat equity, which basically means that I will get equity in the business. I will get a greater number of shares by putting more time, effort, and skills into the business, right? Now, let me show you a case study of a deal I did a while ago. The total capital costs of this one was 2.4 million, 10 units. A monthly cash flow of 25,000, 12.5% ROI. I only at the time of doing this deal had 70,000 Rand available, which, if you take 70,000 as a percentage of the total capital costs, I would only get 3 shares, 3% shares, which is not very exciting because I found the deal, I did the negotiation, I signed the offer to purchases, I've done everything, but I'm only going to get 3%. I'm not being rewarded effectively. So what me and my partners at that time decided is to put a value on the sweat that I'll be putting into the business. So finding the deal, we allocated a number to that, basically called the sourcing fee. Negotiating the purchase price, I got the purchase price about 35% below what it was supposed to be, which means I helped us buy a lot of equity. Once we go through the process of sectionalizing and refinance, we're going to pull all of that money out. And that's because of my negotiation below, right? So there's a value associated to that. I brought all these different players together to raise the capital. That's also a valuable task that one can do. And then I will be managing the investment with my managing agent. So we were able to allocate a value to all of these different sweat contributions that I would be bringing to the business. So the 70,000 that I put in was increased. I added 170,000 in terms of my sweat equity. This was agreed by all the parties, which means that I got a 10% share in the business. So with as little as 70,000 Rand in terms of capital that I could invest, I'm now a co-owner of a block of 10 units, and I get 2,500 to 3,000 Rand per month in terms of a dividend payment. It's not necessarily how much money you have, it's how clever you can be with leveraging other people's money, time, skills, and then bringing your own piece of the pie, right? If you've got a certain type of skill or experience that you can bring to a partnership, that can substitute the lack of money you might be able to bring. I think whenever you're looking at working with other people, you've got to look at that mutual benefit. And I think that's why we called it Kulisizwe, because it was all about mutual growth and making growth something that everybody in the nation can be a part of, which is just quite special. So that is the power of leveraging other people. Sorry, guys, I did go through that a little bit quicker than I normally would have, but I am very conscious of time. Just before we close off, if you do want to know more about how I can help you move forward in your property business, there are two services that I essentially offer. One is that of a partnership where me and you go into a deal together. You will be required to put a bit more capital in than I am, but I will bring a lot of sweat equity. I will bring the deal. I'll manage all of that. And then the second option is coaching. This is where I sit with you on a one-to-one basis. I take you through the steps of buying your first or second or third investment. And I basically just, kind of hold your hand through the process. So if there are any interested parties on this call tonight, please go to my website, lawrenceboole.com. Go look to schedule an appointment with me. You can have a 15-minute conversation sometime next week to see how I can help you. Let me jump into the last few questions, and then I will close off the session. Okay, so Hendrik, how do you find a motivated seller for an investment property? I assume Property 24 is not the best place for a good deal. To be fair, Hendrik, I get all of my deals from Property 24 or estate agents, but that's just because the type of strategy and the area I invest in, that's where all the sellers go. You are 100% right. Motivated sellers is where the money is to be made. In terms of finding motivated sellers, I would say you can go to the auction. To the sheriff's auction is a great place to find motivated sellers. Probably not the nicest thing to do, but something that is really effective is to go and partner with a divorce attorney. Divorce attorneys deal a lot with property purchases and property sales, right? Let's say you've got this couple that are now getting divorced and they've got this property that they bought 5 years ago when they were completely in love and now they hate each other. They want to sell their property as quickly as possible. And they tend to want to sell it quick enough that they'll be open to a negotiation. So you can go to a divorce attorney and ask them for any leads, give them a commission for any successful lead that they give you. That's an option. Otherwise, you might want to work with sourcing agents, people who specialize in providing investment grade deals to investors. The trick with a sourcing agent, just before I move on from that, is make sure that you vet the deal yourself. I know a lot of sly sourcing agents who will make a deal seem better than it actually is. In Tumaleng. Oh, sorry, I did answer that question. Okay, cool. Thanks for covering the cash versus bond. You are absolutely welcome. Let's see here. Kyle, just purchased my first rental unit using a bond. Still need to get a tenant in, but they should cover the total cost, so I should break even. You will, you obviously still have to take into account rates and taxes, levies, insurance, management, and maintenance, and voids. So, just having the rent cover the bond doesn't mean that it's going to be break even or cash flow positive. There's a lot of other costs you have to account for as well. Is it reasonable to think that I could get another bond in a year or two if I continue to break even on property one? How many bonds could you have at once? So Kyle, based on my slides, there is a limit to how many how many bonds you can get. Eventually the bank will stop you. But if you've got a business that has got a good track record, has sufficient assets, and you've got a positive cash flow, there's no reason to think that you can't get infinite amount of bonds. But if you're going to go for the new build strategy, eventually your affordability will run out. Eventually your salary will be too thin to take on another loan. Okay, Ibrahim. So the whole theory of buying a property with no money is BT. I think there's a lot of hype on YouTube and a lot of other, property coaches who say, you can buy a property with no money. I would say it's possible. In my 10 years of doing this, I wouldn't say I know many people or have done many myself. I've done, one or two deals where after refinancing, I pulled out all the money that I had in the deal, and it constitutes a no money down deal. But truly, the only way to do an investment with no money is to source, which basically means that you find a deal, you do the negotiation, you package it, and you sell it to an investor for a fee. Normally, you have to be registered with the Estate Agents Affairs Board, because whenever you're earning a commission off a property sale, you have to be registered with them. But that's the only way. That and maybe a back-to-back. But even with a back-to-back, you still have to pay transfer fees. So, yeah, I think it's more marketing gimmick. I think those people are trying to seduce you into thinking that property doesn't require capital. It does. It just doesn't require necessarily your capital. You can get capital from someone else, use someone else's affordability. But yes, you need money to invest in property. Okay, Alistair, I'm a realtor in Edenvale. Don't buy investment property in Greenstone, Edenvale. No, Alistair, I know you put some comments here. I haven't read all of them, but you can buy in Greenstone in Edenvale. It's still an investment because, as you know, that area is quite up and coming. It's quite suburban. There's a likelihood of capital appreciation. But unless you're multi-letting the properties, you're not going to get a positive cash flow because the rate at which the property is appreciating, the rental is just not keeping up with it. But if you look at a likes like Primrose, I know you mentioned that in the comments, that's a great area for cash flow. It depends on what your strategy is. If you want to be the person that's tapping into the capital appreciation, go for new builds, go for Edenvale, go for the suburbs. If you want cash flow, go inner cities, CBDs, multi-lets. Okay, Darren, how has the FLISP housing subsidy impacted the lower income market, considering folk that have previously rented can now afford to buy? I don't know FLISP so well. I've heard them do a presentation once or twice. I think, if I understand it correctly, they've got the rent to buy model, which basically means that you're a tenant for an X number of years, and then eventually, because you've paid so much rent, you actually take on the ownership of the property. To be honest, Darren, I don't know enough about it. I don't feel like I'm an expert to talk about it. So yeah, I can get back to you. I can do some research, and then at the next session, I'll make a comment about it. Okay, Hilma. What about the expenses you will incur for the sectionalization? Don't you have to take that into account also? Yeah, 100%. So I've already budgeted for that in the numbers. If you're looking at sectionalization in terms of the cost, it's actually not so expensive. You're probably looking at like 5 to 10 grand per unit. It depends how much work you need to do. I've got one block of 9 units where we have to replace every single geyser in those 9 units for it to be applicable to be sectionalized. So that cost is going to be substantially higher than the actual legal cost of doing the sectionalization. Sectionalizing is not a super, super expensive thing. It's a time-consuming thing. The thing is, we don't know if it's going to take 6 months or 18 months, especially with COVID, and that's where I think the risk comes in. Okay. Can you share your YouTube link? Petros, I see that Khopolo's already shared it there with you, so that's great. I'm watching this between showing houses. Where can I watch the full video? Yeah, so you can check out the YouTube link there. Email Hendrik. I'm a realtor and I can get you good deals. I'm very happy that you promote yourself. Anybody can promote themselves on my channel. Please, guys, if you are going to be working with Alistair, do your own due diligence. Make sure you run the numbers. As much as he might present a picture to you, or anybody might present a picture of a good investment, you need to understand the investment yourself before you put any money down. Tommy, Lawrence, I'm a foreigner. I've got temporary residence. Any experience with financing? you know what, that's tricky. I definitely think that the financing for foreigners is very strict in South Africa. My understanding is that you can only get a 50% loan to value as a foreigner, which just makes it very hard to invest because you have to put so much more capital down. I would, if I was you, I would look at partnering with a South African resident to be able to tap into the, competitive financing. Alternatively, you want to use private finance, or you want to use, boutique commercial banks like Mercantile, Combined Finance, Sentinel Homes, Tough, those kind of areas. France, how much do you charge per session? It's roughly 3,000 Rand per session, but you can go check out my website. I've got 3 different packages, and you can see which one suits you. SIPO, the recording will be made available. Okay, here's a good question. Tumaleng, how do you go about advertising for tenants? Now, I'm a very big advocate of using a letting agent. I don't want to be chasing tenants. I don't want to be doing evictions. I don't want to be, inspecting the unit and bringing builders in to do renovations. So 10% of the rent that I get every month gets paid to a company called Landstar. They manage my entire portfolio. They do the evictions. They send letter of demands. They vet tenants. They market the properties on Property 24 and IOL and Gumtree. They do everything. They're also local, right? So I'm based in Cape Town. If I now need to fly down to Joburg every time I need to do an eviction or every time I need to paint a room, I'm going to be flying up and down, up and down. So if you want to manage it yourself, I would say you need to go on a course. You need to understand how to do credit scores and marketing and all of that stuff. That's not something that I specialize in. I just rather use an agent to do that. Same as with Alistair, right? I would rather pay an agent and pay them a commission for finding me a good deal than doing that myself. So it depends what part of the business you want to get involved in. Cool. Tony, is buying a beachside plot and building rental property a good investment? I mean, it's going to come down to the numbers. Traditionally speaking, if you want to buy a property in Knysna or Mhlanga or, any of those beautiful beachside resorts, it's probably not going to be a good investment unless you do Airbnb. If you're just looking at purely renting for long-term tenants, they're not going to work. Now, I can tell you that without even looking at the numbers. If you've got a vacant land and you want to build luxury houses and then you want to sell those luxury houses at a premium price, yeah, I think there's tons of money to be made there. The challenge you're going to get is raising finance, man. Unless you have a development background or you're backed by a big development company, banks aren't going to give you money for developing. That's a very hard way to raise finance. So I think if you're buying land and developing it and then you're going to sell off the property, so you're going to become a developer, I think there's big bucks there. But I do think that's quite an advanced strategy that you probably wouldn't start with. Sure. Guys, I see there's still like 75, 80 people on the call. That's crazy. I appreciate you being here for so long. Let me stop the screen share. You know what? My glass of wine is still quite full, so I'm going to enjoy this. As I've already said, all the content will be on my YouTube channel. Go subscribe, go check it out, go like. If you are interested in knowing more about what I offer, the services, the coaching, the partnerships, just go to my website. We're doing this every 2 weeks or every 2-3 weeks, so make sure that you follow us on Crowdcast so that you'll know whenever our next event is. And yeah, you know what? I just appreciate you guys taking some time out of your Thursday evening to better yourself. Until next time, guys, happy investing, and I hope to see you soon. Cheers.